Hello and welcome to yet another episode of Beat Volatility with Mutual Funds by Outlook Money in association with Aditya Birla Sun Life Mutual Fund. Today we are talking about asset allocation, which actually comprises of 90% of your long-term investment. And to simplify it, we are joined by Aamir Sulaiman, Zonal Head East, AVP, Investor Education and Distribution Management for Aditya Birla Sun Life Mutual Fund. Aamir, it's great to have you with us today. We'll start with the very basics. Investors hear the term asset allocation all the time. So, for the benefit of our audience, can you just explain what exactly asset allocation is and why is it considered the backbone of investing?
So while I intend to answer your question, but before getting into that, I would first take this opportunity to thank you for taking our time to do this kind of session, investor educative sessions, along with Aditya Birla Sun Life Mutual Funds. That is small value addition that we can do towards the investors or your viewers. Now coming back to your question, that what basically asset allocation means is that it's an investment strategy wherein one invests in different asset classes to reduce risk and generate optimal return. So supposedly people are investing in it's not that people are not investing in different asset classes. They are investing into different asset classes, but whether that is by design or whether that is by default. If it is by design, then exactly that is where you will be able to reduce risk and optimize return. So today if I have to interact with, even if I have to ask with you that whether you are doing asset allocation or not, irrespective you are aware of asset allocation or not, you are doing asset allocation. Like you are doing in fixed deposit, you have invested somewhere in the flat, or maybe you would have bought some property. You would have done some here and there mutual fund investment in equity, but that is not by design. It is by default, because if I have to look at your overall portfolio, and if the overall portfolio generates optimal return for you, then only you have done some kind of asset allocation rather than just investing by default. So it's something which is very, very important, and this is something which everyone needs to hooked on to, because that is how you will reduce your risk and generate optimal return.
Okay, that really sets the context really well. It brings me to something that many investors misunderstand. They focus on picking the best scheme or the best stock. So let me ask you, why is asset allocation considered more important than picking individual schemes or stocks?
So as I said, asset allocation normally reduces the risk, and that is what is in your control, because return is something which is get derived from the market performance, whereas risk is something which it's a controllable factor which you can control. If you consider any of the equity scheme or even the stocks, it might during certain period of time it might do great, but sometimes there can be a very big drawdown also. So if that drawdown happens, that is where you need asset allocation, so that there is an asset which exactly have some opposite correlation which minimize that kind of risk, and that is where the true picture of asset allocation comes into play. So that one should not get tempted with the increasing market, or one should not be wary of the downside of the market, so that he is not taking any exposure during that period of time. So this is how asset allocation with the mix of all the asset probably will help in generating better return, that is a risk adjusted return, in comparison to any individual stock or any individual schemes.
So you're very correct. When the market turns volatile, this difference becomes very visible. So from your experience, how does asset allocation actually help investors manage this volatility better and reduce portfolio risk?
So all different asset classes have their own inherent characteristics. So if we talk about equity, although it might generate maximum returns also, but at times it also gives you the highest drawdowns. So far as the debt is concerned, either it is bond or fixed deposit, it provides stability to the portfolio. So far as gold is concerned, it provides you hedge against inflation or hedge against currency risk. So all this may not be available in any one of the asset classes. So all are working in tandem, so that if there is any risk coming in, the other asset class may come for the rescue. So tomorrow, what happens if market, like the way we have seen during COVID times, what happens? The market cracked by 40%, whereas RBI has started cutting rates. So the maximum return was getting generated through debt fund, rather than there is a big crack towards the equity, and that is where debt come for the rescue of the loss that which has happened into equity, and that is how the risk adjustment happened, despite there is an optimal return.
Okay. So for now, somebody building a portfolio, the natural question is the mix should be considered. So what are the key asset classes that a retail investor should ideally have in their portfolio?
So although there are multiple assets, but for a newcomer or an investor who is not conversant of all the assets, although they are doing in different asset, as I said, by virtue of not the design but the default, so they should start with at least debt and equity. So debt and equity is the basic assets wherein one actually helps to provide you the stability, and others try to generate a reasonable return over a period of long time. So debt and equity mix would be the right mix. As the person matures or as the investor matures, there can be an addition of other asset classes like precious metal, which could be gold. Although there are other asset classes available, but that will only be added provided the person or the investor matures over a period of time, and initially one should start with debt and equity only.
Okay, so when someone is just starting out, maybe in their early 20s or 30s and does not have an idea of the stock market, they often feel very confused about where to begin. So in simple terms, how should a beginner think about balancing equity and debt in their portfolios?
So, while somebody is trying to do asset allocation, one has to look into various aspects of investing. So they have to first look at what is his goal, what is the timeline that they want to invest for, what is the risk-taking ability that they have. So all these mix will decide on to the mix of the portfolio. So tomorrow, if I have a ample time in my hands, so any young investors who want to invest in for retirement planning, and the timeline that he has is of around 30 years, 25 years, he can take maximum exposure, can form an aggressive portfolio wherein the allocation of equity can be more. But somebody who is planning a retirement after 50 and there is only 10 years left, so there they have to have restricted amount of equity, because the timeline do not permits you, and the risk taking ability goes down because of the timeline. Hence, you have to consider age, the timelines, the risk taking ability in order to configure what should be your asset allocation.
Okay. So risk taking ability depends on all of these factors, and that is how your asset allocation should ideally be. Okay, so when people ignore this completely, asset allocation, and the results can be quite unpredictable like that. From your observation, what typically happens to investor portfolio during different market cycles if they've ignored asset allocation?
So, take a case for, while there was global financial crisis. So when the global financial crisis happened in 2008, the market cracked by around, the index cracked by around 50-55%. Whereas, the debt were giving a fantastic return because of the continuous rate cut. And the same thing happened during the COVID times also. And when you see that there is a flight towards safety happening, or any risk aversion is happening, you will see some precious metal also moving up, like the way it had happened recently when the world is totally uncertain. There is a lot of uncertainty. And then you will see these precious metal, gold and silver doing great. And that is where you will find that, at any time where the excessive risk is there in the market, the correlation between different asset classes wherein they are negatively correlated helps them to absorb that kind of risk, and that is the absorption which helps in generating optimal returns. So that is how the optimal return with the risk absorption ability, because of the negatively correlation with the asset, helps into stay course. Because sometimes what happen, if you have got excessive drawdown, it is very, very difficult to control the emotions as well. So emotionally, whether you are ready to continue with that investment or not, that exactly push you to withdraw the investment, and that too at a time wherein you should not be doing that. And that is what we have seen during COVID times, when 3-year SIP turned negative, people were stopping SIP, whereas that is the time where they should have done top up or increase the SIP amount.
So in the last 10 years, if you could give me a live example, probably an investor that you would have met, how they kind of diversified their portfolio in the last 10 years to get the maximum benefit of this asset allocation.
So as such, there is no one size fit for all, because asset allocation is dependent on various aspects. As I said, it is mainly by way of what is the age, by the risk taking ability, or maybe the goal that you have decided for yourself. But if you look at the thumb rule, wherein we have seen a general product which is available in the market, that could be multi-asset allocation fund or a balanced advantage fund, there has been a exorbitant rise in the asset management, and that is where people do it through some product rather than doing it himself, because that helps them to give them the expertise of the professional fund managers. And that too, it puts the fund managers so disciplined that it is very difficult for an individual to be that kind of disciplined. And then internally, wherein the fund manager probably can shift the money, the tax implications is also not there. So when you are asking last 10 years, I would rather say anybody can look into the returns and compare it with the high risk product of equity per se, in comparison to the balanced advantage fund or a multi-asset allocation fund. That will give you, the answer which you are trying to, ask for. Otherwise, it's a purely individual, risk-taking ability or the concept that is meant for, that is what the one is looking for as an asset allocation.
So basically, once the portfolio is built, it doesn't end there, right? In practical terms, how frequently should investors review or rebalance their asset allocation, especially in volatile markets?
So, reviewing and rebalancing is something which is very, very important, and that is actually, if you look at the historical perspective, that actually will help you to deliver better, risk-adjusted return. If you don't rebalance the portfolio, if you don't review the portfolio, again the skewedness will be there, and that skewedness may not help you the way you are trying to achieve your goal. So you are trying to achieve your goal by keeping the risk low, whereas you are trying to attain the objective which you are looking for. And if you are not doing the the reallocation or maybe rebalancing or reviewing the portfolio, it might lead to the risk which probably will deter your goal which you are looking for. So that rebalancing can happen on an annual basis. There might be multiple ways to do the rebalance, but what is advisable in general is on an annual basis it should be done. And not only on the time basis, it could be on the basis of if your portfolio drift, if the portfolio has shifted in towards some asset allocation, some assets which gives an excessive risk, and that is where one should rebalance it, or it can be called as a return-based rebalancing or a time-based rebalancing. When it comes to time-based rebalancing, it could be on an yearly basis. When it comes to return-based rebalancing, if the drift is more than say 10%, that is the time wherein one can rebalance the portfolio.
Okay, so considering recent times, for different age groups, somebody who's just starting out, somebody who's probably, mid-30s or 40s and planning for retirement, and then there are people who are already retired. How would you advise them today to rebalance their portfolios?
So, somebody who is actually, about to retire probably can rebalance the portfolio a little frequently because they don't have that much of time. Whereas somebody who has got ample time, if the fundamental remains good, they can always continue with the allocation, provided there is stark change in the fundamental of the asset that they are investing into. So more frequent when you are towards the large stage of your goal that you are trying to achieve, and less when you are into the long, when there is ample time left to do that reallocation.
Okay. Rebalancing becomes very important during sharp corrections in the market, So let me ask you, can a well-structured asset allocation strategy help protect portfolios during these sharp market corrections, and if so, how?
So it's always well structured. As I said, normally everyone does asset allocation. Maybe they might not be knowing that they are doing it, but by virtue of their investment pattern, if you will look at, there you will say they have invested in equity also, they have invested in gold also, in the real asset also, and fixed deposit also. But if it is not in a structured way, if it is not done in a professional, disciplined manner, if it is not getting regularly rebalanced, then there is a possibility that your portfolio will have higher risk, and at the time of any major drawdowns, you may get that deterrent wherein it will push you to the extent that you may not be able to achieve the goal which you are looking for. To the extent means you may think of stopping or rebalancing or not doing the top up, or maybe exiting your investment. And that is how a professional, well balanced, disciplined manner, with a thought out strategy, that this is the kind of allocation that you are looking for, and this is the type of rebalancing that you are looking for, and that is how you will achieve your ultimate objective that you are focused for that particular allocation.
Okay, so if you have to give me in percentage, in volatile markets, what's the percentage of equity, debt and commodities for an investor that you would generally advise?
So we don't advise too much of percentage, but it is, as I said, it is not a one fit for all. It is different asset allocation for different people. But if you look at the combination of say 60-40, or maybe if I have to define it on the basis of conservative, moderate, or maybe aggressive, then aggressive could be 80-20, moderate could be 40-60, or maybe conservative could be 20-80. So 80 equity, 20 debt for conservative, for aggressive, then 80 debt for 20 equity for conservative, and maybe 50-50 for somebody who is in the moderate range. But if you have to ask me the the percentage which exactly will help in generating the optimal return that one looks for, it could be 60-30 and say 10 could be the good ratio wherein one should start with.
Okay. So one asset class that we keep hearing about is gold.
Yeah.
What role do asset like gold and other commodities actually play in stabilizing your portfolio?
So, stability mainly comes from the debt side. So, debt is something which provides the stability. Gold is actually hedge against inflation, whereas gold is also hedge against your currency. You might have seen drastic fall in the currency in current times, and since gold is an international commodity, it hedges your currency risk also, and it also helps you during uncertain times. So when there is an uncertainty in the world, most people will flock into investing into gold because that becomes the safe haven for everyone. So gold is something which provides you safety net for uncertainty. Gold is something which provides you hedge against inflation, and gold is something which provides you as a currency hedge also. So that is how the gold plays a vital role when it comes to asset allocation.
Okay, so gold is enough, but there should be other commodities in the portfolio as well?
So while the beginners can start with, as I said, the beginners can start with two assets like an hybrid portfolio of debt and equity. More nuanced can start with three assets, which could be debt, equity and gold. And more matured investor can start with equity, debt, gold, crypto. There are multiple things which one can look into. Then within the asset, there can be multiple allocation that one can do. It's not that only asset-wise allocation, but within the asset, one can always do the allocation. So for the beginners, for equity, it could be start with index fund or a large cap fund, but somebody who's more nuanced can do asset allocation within the assets also. So when it comes to how far one can do the allocation, then it can be debt, equity, gold, silver, or any commodities, international equity. When it comes to within the equity, all kind of fund which is available. When it comes to debt, all kind of funds which are available. So there are 16 category of debt fund, multiple category, 12 category of equity funds. Then you have gold, you have silver, there are other commodities, there are real estate. So large space or the plethora of assets or plethora of instruments available to do the asset allocation.
So now I want to simplify a very important concept for our viewers, which is dynamic versus static allocation. What is the difference between dynamic and static asset allocation?
So static, as the name itself suggests, that the same will remain static when the proportion has been decided. So once based on your goal, your risk appetite, your risk-taking ability or goal or risk or your age or the goal that you are looking for, there is a allocation which has been decided, say 60, 30 or maybe 10, like that, with 60 equity, 30 debt or 10 gold. So that is going to remain static throughout the period till you achieve your goal. The only thing one can do is while you are traversing the journey to achieve that objective on an annual basis, or if required in between, if there is a sharp increase or sharp upturn in the market, and as I said, it could be a return based or it could be a time based. So time based or return based rebalancing can always happen in order to bring back the allocation to the same level. That is what the static allocation stands for. It will remain static throughout your objective or the goal that you have decided for. Whereas when it comes to dynamic, so it will keep changing depending upon the market conditions. So it is dependent on various models which are available based on the parameters or the trends. So if the market PE or price to book value is different, then the exposure into the equity market will be different because it is dynamic. If the interest rate scenario is totally different, if it is coming down or going up, my exposure to the debt will be different. So if there's all uncertain situations wherein I have a mandate to increase gold to the extent of 5 to 20%, I can raise it to 20%. So it is totally dependent on various market parameters or the trends which are currently trending or which are available, or the balance sheets which reflects how the profit or the revenue is growing, and that is how is helping somebody to get tempted to increase the exposure more. So it is totally dynamic basis the current market scenario, current interest rate regime, current policy framework. These all will help anybody to increase their ratios in that particular asset class wherein that influence the major return which is going to come from that particular strategy. So static is mainly remain static, whereas the dynamic will keep on changing depending upon the market conditions.
So dynamic asset allocations, I'm sure fund managers would be reviewing and rebalancing your portfolios accordingly. Do investors who apply the do-it-yourself kind of strategy, are they more dynamic or they more static in nature like that?
So market makes people dynamic or static. So what happens if market is behaving positively, then the greed comes into play, or if the market falls exorbitantly, then the fear comes into play. So if you talk about the investor get tempted with the trends. Why so? I'll tell you why so. Because if you will look at the market, when the market is at the downtrend during the COVID times, when the index was somewhere around 25,000, there were very few inflows in the market. Whereas as market trending upward, the flows keeps on increasing. So when the market is at its peak, you will have the highest inflows in the market. So that typically tells you that investors are chasing what? Investors are chasing return. So they are not themselves so disciplined or professional to keep their allocations intact, and that is where it is important to have your advisor in place or a fund manager in place, so that you should not get influenced by your emotion or do not get influenced by the trends which you might see it in a very different way, but that is going to hamper you in a very negative manner. And that is where you require a fund which exactly works on certain principle, which has got a very discipline in place. Irrespective of any emotion, the fund manager is working behind the scene, and he is trying to maneuver it to the extent that you should not get away with your objective that you have planned for. So if you are doing it directly, you are doing it yourself, it is okay, but the trend says, history says that people chase return, people chase market, and currently if you look at the maximum money which is coming into net sales, which is happening into mutual fund, is into gold and silver ETF. And that is again the same philosophy, is that people are chasing trends and people are chasing returns, and that is where emotional buyings happen. If opposite happens, then that is the time to invest, the people will not do, and that is where the fund manager's role or an advisor's roles come into play, so that they put them into discipline, have some broader strategy in place to do the allocation as required by your individual risk when the advisor is working for you, or as per the fund mandate when the fund manager is working for that particular fund.
Okay, so is a dynamic asset allocation more effective than a static approach in volatile markets?
Not necessarily, but dynamic, if done properly with all methodology in place, in all professional way, because it's again taking a call. The call might go right, the call might go wrong. So if the call is all right, if you have an history of taking a right calls, and that exactly will do better in comparison to the static. But as I said, not necessarily. It is dependent on the individual expertise, wherein if you are making a call, that call has to go right. Whereas if you compare it with the static and the dynamic, now if you are with the safe hand, with the better hand, you will find dynamic doing better in comparison to the static.
Okay. So at the heart of all of this is investor behavior. In your view, can asset allocation actually help investors avoid a behavior mistake such as panic selling or chasing momentum?
Yeah, of course it will. And that is the biggest, everybody is the biggest proponent for asset allocation. Because as I said, when the market fall, wherein one has to take plunge for investing, people don't invest. And when the market is at peak, you will find a lot of money coming into it. So this is the trend all across. If you look at the household savings number, the maximum generating asset, the maximum return generating asset is equity. Whereas the allocation in equity is what? Minuscule in comparison to, you call it property, real estate, or maybe fixed deposit. The household savings into equity is minuscule. So still there is a lot of money, which is required to come into equity in order to have a balanced portfolio. But as I said, it is not that easy to ride that volatility, because when you see market going up, people will start coming in, and if you will see market going down, people will exit that route. And that is where the asset allocation plays a vital role, so that it keeps people to the discipline. It it does not eliminate risk. It never eliminates risk, but it will reduce risk to the extent that one should not go haywire, and then it also bounce back earlier in comparison to the single asset exposure, so that you stay course with the objective that you are set for. So both ways, when it falls, it will fall less, but when it bounce back, it will have a earlier reverse happening, or return generating portfolio for you, and that is where it will test your patience. So if you are into a single asset, you may lose patience because of the long recovery which the time is going to take. But if you are there with multi-asset, if the recovery happens sooner, you have already gone through that patient level, and you are stay tuned with that investment, and it will help you to achieve that objective.
Okay, so some of them you've already mentioned, and experienced investors also sometimes go wrong. So what are the other common asset allocation mistakes that even experienced investors tend to make?
Mainly, when they don't rebalance it, they get tempted, greed, or they get fearful. When the market is down, they become fearful. When the market is up, they become more greedy. They don't do the reallocation part. And these are few common mistakes which everybody does. Not that, even I being into the market for multi-years, sometimes I also take my own time to get my portfolio rebalance, getting tempted to the return which is coming on. So people will try to stay, hooked to the investment, as they don't foresee too much of risk coming in, but you don't know from where the risk is going to come. And that is where we call it like a VUCA world. So it's a VUCA world. Anytime anything can hit you, and that is where we do mistakes. And that mistakes can only be sorted out by help of appropriate discipline process that is there in place. If there is no appropriate process or a discipline, or as I said, rebalancing, which is not happening, it might lead to sometimes a disaster also. Because I'll tell you, the return which people have made during the 2008 financial crisis, the index has fallen by 50-55%, but within the asset class of equity, if you look at the small cap, people have lost 70%. Somebody who would have lost 70%, it's very, very difficult for them to hook on to the investment, and maybe they will seek refuge by redeeming the money, because they might be looking at whether it will become zero. And that is the type of question people come out with whenever you feel, or whenever you are hit with these kind of drawdowns.
Okay. What is the advice that you probably give all investors, or whenever you are doing these investor education initiatives? What is that one advice that you actually give to all investors?
So one is, as we are doing this particular program related to asset allocation. So one advice is asset allocation, and that is how one can always reduce the risk to optimize the return. If you compare it with any time, and you look at the returns of various asset classes, and look at the risk that they carry, and then mix it with the portfolio, you will always find that while it might have generated little lesser return, but the risk safeguard is much, much higher. And that is where one need to look for, because that is something which is in your control, as I always say, because returns are driven by markets. So returns market, if the market is doing great, you will make return. But the only thing which actually is in your control is to reduce risk or to control the risk. And the only way to reduce the risk is you have to mix your negatively correlated or low correlated assets together. And that is where asset allocation is something which is very, very important. Another is you have to be very disciplined investor, not that you do it on an ad hoc basis, and it has to be goal oriented. You have to fix the goal, you have to be very disciplined, not an ad hoc way of investment, and it has to be asset allocation. So these are the few advice which I would like to give to all the investors.
Okay. Finally, given today's environment, which is filled with global uncertainty, there is interest rate shifts, geopolitical risk, investors are always looking for clarity. So to wrap it up, what would an ideal asset allocation framework look like for long-term wealth creation in today's environment?
I may not be able to give you the exact percentage, but the ideal allocation will always depend upon individual risk taking ability, or the goal that you are looking for, or at what age you are planning for. These are the few basic template wherein one can devise a strategy of allocation. As I said, asset allocation is a strategy. So it can be conservative, it can be aggressive, it can be balanced also, or moderate also. So if somebody who is at the age of say 25 and maybe looking for 10 years of investment, their exposure to equity can always be higher, because equity, the only way to manage equity risk is to stay put. When I say stay put, is to stay long. So when you stay long, the intermittent volatility will automatically come down. So if you have ample time, then go overboard to the equity. If you don't have that much of time, have a balanced approach. And if you have minuscule time, maybe 2 years or less than 3 years, then overboard towards the conservative, that is the debt side of the portfolio.
Okay, what's your one golden rule of investing?
So one golden rule of investing would be allocate basis the asset allocation, allocate basis the goal. So if you have a short-term goal, the allocation can be done accordingly. If you have a medium-term goal, allocation can be done accordingly. And if you have a long-term goal, then the allocation can be done accordingly. So if it is a short-term goal, even within the debt category, you need to choose the right schemes for that particular goal. If it is a medium term, then obviously even in the debt category you can take some kind of risk, maybe the duration risk or the credit risk. If it is for longer period, then obviously equity will be the man behind your return generating portfolio.
Well, that was very insightful. I'm sure our audience would be allocating their assets now mindfully and thoughtfully. Thank you so much for joining us today, Aamir.
Thank you, Ankita. Thank you very much. So finally, I would like to close it by saying that you have been doing a great job in educating your viewers. It is I should say, our privilege to have hand with Outlook, so that we keep doing this kind of session, and that is, as I always say, that is how we will touch lives of a lot of viewers and investors, and that will help them to achieve their financial objective in a very understanding way. So it should be they should be achieving their objective in a more informed investor basis. So that is the idea, that whenever we do such kind of programs, it should be more to educate the investor so that the investors take informed investment decision. So thank you very much once again.
Thank you so much. If there is one takeaway from today's conversation, it's that market will be volatile, but what will give you stability in your portfolio is asset allocation. Keep watching this space for more such conversations. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.